All right. Hey, everyone. It's Investment Tuesday, and it's hot here in North Carolina, and it's hot in the markets, right? So hot. I wore my sunglasses, my aviator sunglasses. All right. Now I'll take them off. Um, welcome to Investment Tuesday. And in today's Investment Tuesday jam-packed issue, we're going to focus really on what I think is the most important thing to think about today. And it's not whether Nvidia stock will jump higher. It's not an AI play. I'm here to tell you that I think there is something that is happening, and from my 30 plus years of experience, there is just there's something in the air, there's something in the water that tells me that we should be paying attention to this. And yeah, I'll say that most likely it's something that very few people are talking about because we're too consumed with AI. And now we've got obviously, the events of this weekend, which is the United States taking out the nuclear capabilities of Iran. There is now talk about a regime change in Iran. There's all of that going on, but in my view, this is still the most important thing. And I'll just say, even all of those events of this weekend play into this general thing, which is that people are blasé, people are complacent, people are not really thinking about risk, when in my judgment the risks are piling up. And I have, in the last two YouTube videos, I've laid out the scenario under which I think we're going to have some, I don't know what the right word is. I mean, maybe some people want to call it a crash. I don't think it would fit my idea of a crash, which is like 2008. Dislocation, volatility, instability, some amount of chaos, a lot of moving around. But nobody really is talking about that, and I want to talk about it because, of course, after it happens, then people are like, well, if you thought that, Paul, why didn't you say something? So I'm saying something. Now, what you choose to do with it, yeah, you can, let it go out through this year, through the other, troll me, today's world, anybody that, presents a point of view that other people don't like, it's, you make yourself an object of criticism. And so be it. So be it. But before I get into all of that, I want to put up our legal disclaimers and disclosures, which is that this video and the content from ATG Digital, which includes our Substack, obviously this YouTube video, the trades to our portfolios, the updates we put out, I mean, we put out a lot of content, is not investment or financial advice. It is presented to you as my opinion, our view, our take on the world. You use it as information, use it as engagement, use it as entertainment, whatever you choose to do with it, it is your responsibility because it is your money. All right. Next, all ATG Digital content may contain errors, oversights, and mistakes. In other words, just because we say it doesn't mean that somehow we have not, we don't know every last detail about it, or maybe the particular fact that we thought was true turns out, our source either got it wrong or we got it wrong, whatever it is. Understand that investment operations, which is what? Buying or selling a stock, buying or selling an option, buying or selling a crypto, they have significant risks and can lead to the loss of your principal. Loss of your principal means losing money. Nobody needs to talk about the reverse, which is making money, because everyone's happy when that happens. I hope everyone's happy. I, the owners, employees, contractors of ATG Digital, we own, we trade, we transact in the securities that are mentioned in this video and all of the content from ATG Digital. We do not take money from companies or crypto promoters, sponsors to recommend their stocks or crypto tokens. If you would like to see the vast array of free content that we put out, which includes our Substack, which includes the Ball Man Speculating podcast. And obviously, if you're watching this, you know about YouTube, where I come on every Tuesday, and my colleagues Dean and Dan also come on a regular basis. Social media, I am pretty active on X, and we are somewhat active on Instagram and Facebook. Finally, if you would like ongoing coverage of the issues I bring up, stocks and crypto or securities or investments that I bring up, the way to do that is to get a subscription from ATG Digital. We have various different tiers, more or less based on market capitalization. Silver tier is the one that has generally bigger stocks, bigger crypto. That begins at $9.99 per month. And from there are others. If you go to our website, atgdigital.media, it will give you all the details that you want to find out more. Okay, so let me get some charts up. This is a chart of the various indices that people tend to follow, which is the Russell 2000, which is a index benchmark portfolio of pretty much all the small companies that trade on the exchanges in the United States. We've got the S&P 500, which is 500 of the largest companies that trade in the United States. Then we have the NASDAQ Composite, which is all of the companies that trade on the NASDAQ Stock Exchange. In case you didn't know, there are two stock exchanges, New York Stock Exchange and the NASDAQ Stock Exchange. So this is all the companies that trade on the NASDAQ Stock Exchange. And all the biggest companies of today, think the Mag 7, pretty much all of them trade on the NASDAQ exchange. Then we've got the S&P 500 equal weighted. That's the brown line. And equal weight means that you have to understand what the regular S&P 500 is, which is that it is a cap weighted. In other words, the biggest companies get the largest weight. And equal weight means whether you're Apple or you're the tiniest company in the index, you get the same weight, which would be 0.25%. So obviously, when the big companies do well, the cap weighted index does much better. And when the smaller companies or the vast majority of companies do better, the equal weighted version of the S&P 500 does better. So in some ways, you can think of it as like, when there's a lot of concentration, like there is today, where the Mag 7 and the top 20 or 30 stocks essentially capture the vast majority of the index, the cap weighted version does very well. When you have a lot of small caps moving, that will generally mean that the equal weighted version is going to do better. And then finally, we have the QQQ, which is the NASDAQ 100, which is 100 of the largest stocks that trade on the NASDAQ Stock Exchange. That also is, pretty heavily weighted towards the Mag 7 and all of these tech stocks, etc. But that is not the point of this chart. The point of this chart is to show you what has happened with all of these portfolios, which professionals track on a regular basis, which is that we had the Liberation Day announcement, which came right about here. So April 2nd, then we had can we call this a crash? 22%. I know in today's world, people would call that a crash. By 2008 standards, not a crash. Maybe by today's world, that's a crash. Certainly the speed of it is crash-like, but the magnitude is not. And then there has been a rapid recovery. In other words, at least if you own these indices, for the most part, they've all sort of now sitting above, for the most part, sitting above where they were prior to President Trump's Liberation Day, the official launch of the trade war. That's really what I would call it. Pretty much every index other than the Russell 2000, which is the small cap index, every index is up and up big. They're not hitting all-time highs, but they've come really, really, really close in 2025. And many of you and many market observers, participants, gurus, the commentary at people like me, but not me, think that this is all completely normal and that higher prices for stocks are justified by the fact that economic growth has been pretty good. We've got, of course, this mega innovation trend, artificial intelligence, which is going to boost productivity, going to boost earnings estimates. And also recent inflation numbers have been modest. And hence that must mean that, stock prices should continue to go up. And my view is different. My view, as I've been laying out in YouTube videos, is that we face a major problem that markets are not considering and not really considering, or else the stock markets are living in one world where they're like, bond, schmond, who cares? We got AI. We're just going to bid these stocks higher. And the bond markets, on the other hand, are looking at record amounts of debt that needs to be issued, not just by the United States, but by Japan, by China, by the European Union. The major countries in the European Union are Germany, France, Italy. UK is not in the European Union, but and what this chart shows is, this starts at 1 month, which is 30 days, and now you got 30 years on the other side. Essentially, what this shows is the spread between very short-term bonds. Bonds are what? Well, we're lending money to governments, right? That's what a bond is. You're lending money, right? Or the government is borrowing money, and it borrows at different rates. Now, let's look at the USA. So that's the blue dots. You'll see that for us, the USA, the 30-day rate to lend to the US government, or for the US government to borrow from us, is about 4.2%. And the 30-year rate is about 4.83%. So it's about 0.6%. Just imagine, right? Having gone through COVID, having gone through the enormous spending that the US government did during COVID, the fact that the Federal Reserve kept interest rates at crazy level lows, even as inflation was rocketing higher, telling us that it was transient and that it would move on until it got to 9%, and then it pushed rates higher. But we really haven't seen long-term interest rates really, separate themselves from short-term interest rates. As you can see, this blue line, which represents all the various sort of maturity levels. So let's, I talked about 30 days, which is 1 month. I talked about 30 years, and you can see the spread essentially is nothing. In other words, do you really want to lend the US government, or let the government borrow from you for 30 years at 4.8% when you have the choice to just give them money for 30 days and you can get, 4.1 to 4.2%? Well, investors are voting to take 30 days by a lot, and they've been doing that for several years. So, people thinking, oh, this is about Trump and this is about, no, this is really about the fact that bond investors are not dumb. They understand that there has been vast amounts of money issuance over the last 5 years that has tilted the demand supply scales for money, meaning that there's too much supply of money. And even though inflation rates are now between 2 and 2.5%, 3%, we're not back to where they were in 2019. So I asked Grok AI, which is that, here's the original query, which is that what is the cumulative amount of inflation the US has experienced since the beginning of the year 2019? Right, I wanted to start with something pre-COVID and, include one pre-COVID year. And so using CPI statistics, this is what the ultimate answer was, which is that based on historical, final answer was that cumulative inflation between 2019 and up to now is about 30%. 30%, right? I mean, that is how much inflation we have had since COVID. And I also asked Kwok that, based on historical experience of how bond markets move, what would be, a normal rate if that had happened? And it says that, for the 10-year treasury, it would be somewhere in the range of 5 to 6%. 5 to 6%. So right now, I showed you this, which is that, and I'll just now isolate the USA by itself. I mean, the blue line is where we are in terms of bond rates, right? The 1 month is at 4.2. The 30-year is at 4.84. The 10-year, the 10-year is at about 4.3. Yeah, I mean, we're nowhere near 5%. I mean, the 30-year is nowhere near 5%. The 10-year is nowhere near 5%. And I've also asked Guak multiple times now to lay out what are the funding needs of the US government and the other governments that are listed on this chart here. No, not the United Kingdom. The United Kingdom is pretty small. I mean, the big bond issuers are the United States, the European Union, Japan, and China. Those are the main bond issuers. And Grok says, and I've double checked this, which is that the US by itself has to sell somewhere in the region of $8 to $9 trillion worth of bonds in 2025, right? In 2025. So we got 6 months left. And all the others, the European Union, Japan, mainland China, they also have, an additional, 11 trillion, something like that they have to sell. And so when you look at this, right, and I tell you that, which is that let's just round numbers higher, which is that the world's economies need to spend, need to raise something like $20 trillion, right? Do you really see the world's investors wanting to throw $20 trillion at these rates, whether it be to the United States or to the European Union or to Japan or to mainland China? I'm not seeing it. I am not seeing it. And so I have laid out now for about a month, I've been talking about this with you on YouTube. I've been laying out things to subscribers, making changes to our portfolios for something to happen. Of course, the natural question that people will say is, well, Paul, what you're saying sounds reasonable, but why hasn't it happened already? I mean, hey, markets take their time sometimes they're in a rush. Sometimes, for whatever reason, that critical mass doesn't appear to move rates. Or sometimes it can just be that it doesn't have to happen abruptly. It can happen slowly where, maybe there's just, one 10-year auction moves, this rate higher and it moves up by 0.25% a little bit at a time. And it's not so dramatic. Hard to know exactly how things it is. And nonetheless, this imbalance, given the amount of demand, given the amount of bonds that have to be issued, is enormous. And if markets were here, like where they were at the bottom, right, in April, at the bottom of the Liberation Day panic, crisis, crash, whatever you want to call it, I would not be concerned. You know why? Because that would seem to discount or anticipate or expect that, hey, there's going to be some broken pieces here to all of this. But that's not where we are. We instead have rallied back up to pretty much near the highs when the world has changed, right? I mean, the world has changed a great deal. Obviously, we've got, 2 wars going on, 3 if you count the India and Pakistan thing, which almost blew up into a full war. We've got a trade war that's still on. We've got deadlines coming up in the first week of July for the rest of the world. Then we've got in August the China deadline coming up. Um, we've got the government trying to pass a budget bill that is going to increase the deficit, increase the debt, and increase the amount of bonds that need to be sold. And stock markets are like la 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 la. Who cares? And my um, my experience in stocks is that one of the tells, if you will, when the stock market is sort of um, in a completely different world than the bond market is when the spread of junk bonds over treasury bonds is at lows. And the reason for that is that if you're a portfolio manager and you've been managing money, many people would consider junk bonds and the returns they provide, which are, you get higher returns for higher risk, a kind of like equivalent to stocks. In other words, there's more risk there because the defaults are higher, so you expect more. And so when the spreads over treasury bonds, which are risk-free except for inflation, are very low, it suggests that people are blasé about risk, complacent about risk, not taking that into account. And if you look here, this is a chart comparing junk bond spreads over treasury bonds since 1997, and you'll see that there are points in time when the spread jumps higher. Like, for example, in 2008, the spread jumped higher. Why? Well, there was the global financial crisis. Nobody wanted to own risk assets. And so junk bonds sold at this enormous spread. Like there's a 20% spread versus treasuries. Obviously, that was a buy, but nobody wanted to buy. Why? Well, they're filled with fear, right? I mean, and also people were very long loaded up already here, right? From 2005 to about 2006, they were buying junk bonds at very low interest rates. They were unprepared, right? They owned too much, so they were forced, they were liquidated. They had to sell. And as everyone went to sell at the same time, remember, as bond prices go lower, the interest rate goes higher. So, of course, interest rates spiked up, but nobody was there to buy. A few people did, and they made good money, right? Since then, we've really not had, and we've had a mini panic here, and one obviously in 2020, which was COVID. And you can see generally when you start at very low spreads versus junk bonds, it generally suggests that people are taking too much risk. Markets are not anticipating any trouble. And whatever signal that there is, people are like, well, I don't want to miss out. Stock prices are going up. We got AI, we got NVIDIA, and everything is good. Who knows? Maybe this will work out. Obviously, once it spikes, we care. Once we spikes it, we care. And then we end up selling over here when that's actually the buy point. Right? I mean, so all of this is to say that we have something that is going on in the markets that the vast majority of people are not talking about, which is there are risks associated with the long-term interest rates, which are associated with the amount of money that governments around the world, United States being one of them, and the biggest one, that they need. And where current interest rates, in my judgment, simply do not account for the vast volume of bonds that need to be sold in 2025. Now, if we had to sell these over 3 years, I would be far less concerned. But AI, which is what I'm using as my research, says we need to sell these in 2025. Right? And a significant amount of these will have to be 30-year bonds and 10-year bonds and 5-year bonds. We cannot sell $8 trillion worth of 30-day treasury bills. There is huge demand for 30-day and 90-day treasury bills because everybody's like, hey, when this happens, I don't want to be in the 30-year bond. I don't want to be in the 10-year bond, All right. I mean, when uh, when interest rates blow out, as I have been saying, um, nobody will want to have been, already have bought the 30-year bond. Why? Because it's a bad deal, right? I mean, if you're buying a bond today and you're being paid what, right? Let's go back to this one, right? Let's say you're a buyer of the 30-year bond today, 4.84%. And let's say I'm right, and the 30-year bond come year end is at 6%. Yeah, I mean, this bond's a bad deal, so its price will have gone down, right? So for context, a move of 1%, 1.5% in the bond market is enormous. Just to be clear, it's enormous. It's not a small number, it's a big number. And it will reprice all risk assets. It will not just be bonds that get repriced for it. All risk assets will be repriced for the new interest rates. And that is where you will get volatility. That's where you will get instability. That's where you will get dislocation. Now, going back to this, I don't expect this dislocation, this volatility, this instability to be something that causes 2008. I just want to make this clear. Why? Because, when this happens, if this happens, no guarantees, it's going to obviously lock up markets. I mean, the junk bond market will most likely lock up. The demand for corporate bonds will sink. If you're getting 5.5%, 6% for 10-year or 30-year Treasury bonds, money will come out of cash and chase those yields higher. And the Federal Reserve will then be forced to cut interest rates. So that will drive a very steep yield curve. In other words, going back to this chart, and let me just use the USA as an example, we will see a yield curve. I can't even show you, let's say 2% is here, right? So imagine a yield curve that just looks like a straight line up like that, right? In other words, it starts at 2%. Let's just say, the 5-year is at 4%, or is at 4.5%, somewhere here. And the 10-year is at 5 or 5 and something between 5 and 5.5%. And the 30-year is somewhere out here at somewhere near 6%. That's a steep yield curve, right? In that scenario, that is very, very, very positive for economic growth. And the reasoning for that is kind of simple, which is that's a scenario in which other than the central bank, who creates money? It's banks that create money. So if there is a scenario where short-term interest rates are at 2% and long-term interest rates are, let's say, at 5 or 5.5%, let's say 3% spread, it is very worthwhile for every bank to take in deposits from people. And remember, we have no choice at that point. For cash, you hand your money over to banks and you hope they'll give you something, or even, money market rates or whatever. They'll all, get compressed down to 2%. Banks will take that environment and be like, hey, hello, business, would you like a loan? Take a loan, please. Why? Well, because we make 3%. Nice, big, fat, chunky spread, right? Between short-term interest rates, which is what, banks pay out depositors at, and what they charge borrowers, right? So that's a great environment for banks, and they will push money into the system, right? That will stimulate, of course, a lot of economic growth within the economy. Banks don't, really push money really into markets. I mean, some of that money will push into markets as well, but it will chase the kinds of opportunities that cyclical growth generates. In other words, small cap companies, they suddenly will have access to credit when they generally have not really had good access to credit for most of the post-global financial crisis period. Cyclical companies, which are what energy companies, chemical companies, all of these companies, which are sort of like no one really thinks about. Banks obviously will do well. So this is not a scenario in which everything goes down, stays down. I think it's going to be more like an up and down scenario. Some things go up, some things go down. And one of the things certainly that I believe will go up in this scenario, especially if things happen abruptly, will be gold. If you're a subscriber of ATG Digital, starting about, I think it was about 30 days, maybe 45 days ago, we started to buy gold mining stocks, and we've got a number of, winners there. And I expect the gold to keep going higher. This is the gold ETF, so it doesn't really tell you. Let me put up the actual gold commodity so we can see the actual gold price. So you can see gold hit a high of about $3,500 in the post-Liberation Day panic. That's important because we now can tell what, people around the world are concerned about the amount of bond issuance that is coming, and they are betting on gold. And that will continue even more, because if I am right and the 30-year bond blows out to, let's say, on the low side, I don't know, 5.5%, high side 6.5%. It will be because people think that long-term inflation is obviously not under control, that people want higher compensation, higher interest rates for a 30-year loan to the government. And in that scenario, people be like, well, obviously that inflation, means that, the value of scarce things like gold, is higher. So gold, my judgment, we'll see a huge boost. How high can it get to? Well, I mean, the next round number is 5,000, so that's too low in my judgment. The next round number after that is 10,000. Yeah, I mean, we could see a huge spike in gold coming through because gold has not really done that much over the last 20 years, right? I mean, if I move this chart to, I think this goes from 1979. I mean, it was at 400 and it was at $417 in the 1990s. That did a low of 250 in 1999. But I mean, you go back to the last real, big bull market in the 1970s, it hit about, it was near 1,000, and we're at 3,500. In the meantime, the amount of money that's been issued in the world has to have, I don't know, quintupled, decatupled, I don't know, pick your number. So a lot of upside here. And the mining companies will benefit. Gold will obviously benefit. Many people will question this one, but Bitcoin will also see a rocket ride higher. There's going to be a lot of skepticism about this because our hopes for this cycle were so high, driven by past analysis, which truthfully has missed certain things, right? And I will put my hands up and say I'm guilty of having missed this, which is that since Bitcoin is such a new asset, right? It comes about in 2009, so it is 16 years. That is nothing. Like gold's been around, 1,000 years. I mean, the stock market's been around 100 years. Bond markets have been around, 100 years plus. This is a very new market. So we are still in the early stages of working out what moves people to buy and sell this. And we are at a crux point for Bitcoin, which is that there is still a large number of people that see Bitcoin as a pure speculation, right? And that is kind of like the old world. That is the retail audience. They're using perpetual futures and 100x Bitcoin futures, and they drive the short-term volatility higher and lower. And so in response to, for example, when the news came out that the United States had attacked the Iranian nuclear facilities, there were a lot of people who owned many of these perpetual futures, which again have 100x leverage, 100x, right? I mean, they got liquidated out. And that's why you can see here very recently that, yeah, in, yesterday, you see a low of $98,000. I mean, this is really a lot of short-term traders using a lot of leverage, getting liquidated out. However, we also know that whether it be BlackRock, all of these treasury Bitcoin companies, I mean, they are buying up Bitcoin um, and to hold, right? I mean, and this is the faster growing part of the Bitcoin market, right? I mean, whether it be Strategy, which used to be called MicroStrategy, or all these companies that are now, adding Bitcoin to their balance sheet, either to boost their stock or to get publicity. Nonetheless, whatever it is, it's a bandwagon that's rolling, right? I mean, so between that and the Bitcoin ETF, Texas just passed, I believe, a bill, starting a Bitcoin reserve. The United States, has the idea of a strategic Bitcoin reserve. Whatever it is, all of these are going to absolutely, you know, uh, completely overwhelm the old school like retail demand. Right. So into a scenario that I'm talking about where long-term interest rates jump, short-term interest rates get cut, markets react to all of this, in different ways. My view is that, initially, of course, there's a panic, which, moves things down. I theorize that, we revisit the in terms of the S&P 500, the lows. And then from there, we start to see an enormous rebound, but in very different things than what most people own. It'll be in gold mining stocks. It'll be in cyclical companies. It will be in many crypto, Ethereum, Bitcoin, etc. Why? Because, well, cutting short-term interest rates will flood money into the economy, and that money will have the greatest impact on the most scarce assets and also the most illiquid assets and the things that have the greatest demand and supply imbalance. In other words, what people don't own, but is going to be benefited from the new environment, which is a steep yield curve. And that is small cap stocks. That is cyclical stocks. That is crypto. And so that's where I would say the opportunity is today. In other words, people are chasing, well, I'll call, the heroes of the last bull market. But my experience is that the new bull market is always in a different place. It is always something that people are not in, not expecting. It's because why? Well, because when you look forward, the analysis I've laid out is obviously not that easy, not that interesting. Then, talking about, hey, here's the next AI play and it's going up 100x to the moon tomorrow. Just not quite as sexy as that, right? So people are positioned, in my judgment, in they own the wrong things. They own likely too much of it. Some people are levered up because their expectations are driven by high stock prices, and they're not accounting for risk. Really, they're not accounting for risk. So for me, I would tell you that the places to be really right now is, the things that will get bid up as, things start to sort of like move around, right? I mean, if long-term interest rates, if, because how will this long-term interest rate repricing happen? Remember, the Federal Reserve does not set interest rates for the 30-year bond or the 10-year bond or the 5-year bond or the 2. They set something called Fed funds. It's a way to influence interest rates. But the bond market sets that. And the way they set that is that the government holds bond market auctions to sell debt every month. And those auctions will have to produce buyers, right? I mean, so if the government wants to sell a lot of debt, and if people don't come at 4.8%, then what? Well, I mean, then the auction will go to 4.9%. And if people don't come to buy at 4.9%, it will go to 5%. If people don't come at 5%, they'll come at 5.1%. In other words, the auction will simply adjust the rate until buyers come in and take the bonds that the government has sell. And once that new rate is established, I mean, of course, as that auction's happening, people around the world, are bidding in this auction. They're tracking it. Everyone understands that will reverberate through all of the markets, right? I mean, and that is the way that this repricing will happen. In other words, buyers will show up at auction and simply say, "Wow, you want $100 billion of 30-year bonds at 4.8?" No. Yeah, I mean, maybe there's $5 billion worth of demand at 4.8. Maybe the next 15 billion wants 4.9. Maybe the next 30 billion wants 5.2. And now you can see how the interest rate will adjust up as it adjusts higher. Anyone that owns a lot of bonds or that owns stock in companies that are affected by rising interest rates, because a higher interest rate for the 10-year bond or 30-year bond is also going to reverberate through corporate bonds. And this is where that spread matters. If the spread was already high and this happened, it's already discounted. It's already, it's sort of like people have adjusted for it. But if the spreads are very low as they are right now, the spreads will blow out. Companies that need funding this year, next year, people will start to, anticipate that, wow, they can't make interest payments, they can't get their bonds funded. So this is the dislocation, instability, volatility that, that I expect will happen somewhere. I mean, everything suggests that it should happen in the 6 months, but things can take longer. I mean, I remember in 2006 and 2007, things took a long time. So I'll say happens in the next 6, 12, alongside 18 months. But nonetheless, I just can't see how the US government can issue $8 trillion or $9 trillion worth of bonds at current rates. And if that is correct, then it will have serious and real ramifications for all assets and all asset classes across the board. So what can you do with this? Well, I mean, it depends on you, depends on your time frame, depends on your risk preferences. Again, because this is not like, everything bad. This is more a scenario of, this is sort of like an up and down scenario. We first have long-term yields that go up. In response, there's dislocation in the market. That drives the Federal Reserve to cut, which drives liquidity into the economy, into markets as well. And then, a new set of assets that benefit from a steep yield curve, they get bid up and they're in a bull market. Yeah. What can I do? I don't, get to make these scenarios up. I can just tell you, this is what I see unfolding. And I think it's important that people understand where we are. I've been talking about this, the HEG Digital subscribers, pretty much, for, I'll say, 2 or 3 weeks now in different ways. But the picture is becoming clearer, and there's just more and more signs. Everything I look at, everything from put call ratios to, the exposure of portfolio managers, everything is pointing to the fact that people are blasé, people are complacent, and that is generally the environment in which things happen. In that scenario, I think gold goes up. I think the initial impact is, kind of like for Bitcoin is where people will sell, then immediately the new demand comes in and bids it higher, sort of like what happened this weekend, right? I mean, the retail traders got liquidated, on Saturday and Sunday out of all their perpetual futures. And then, of course, institutional buyers just came in and sucked up 98,000, sucked up 99,000 Bitcoin, $100,000 Bitcoin. They're just, and I think something similar will happen there, which is that there'll be some volatility, but because there is so much demand, that will drive, Bitcoin prices back up. Nonetheless, that's my Investment Tuesday take for all of you, which is that the world is changing. There's a lot going on. There's a lot of moving parts. Uh, don't be in a panic. Remember, markets long term are where you want to be. ATG portfolios, we have prepped for this. We own a lot of companies that benefit from a cyclical upturn in the economy. In other words, a steep yield curve. We've got gold stocks. We got crypto. So yeah, there will be volatility. There will be instability. But the long-term gains and the big money is always in the long term. So that's where I would tell you to be. But use rules of the game. Use rules of the game and understand that when I talk about a stock here or crypto, it's just one in like a 50 plus, portfolio. Just like the S&P 500 is not one stock. You may treat it like one stock, but it's 500 stocks, right? So diversification is your friend. Making all in bets on one single stock, bad idea, especially in periods of massive volatility. That's not going to stop anybody. I'm sure plenty of people do that, but that's my guidance at this moment, which is that it's a time to be mindful of risk. It's a time also to look forward and look at the opportunities that are going to be coming your way, which are going to be huge. I am still bullish. I am still optimistic. I am still positive. There's big money to be made in this, in this bull market, and Bitcoin, crypto, electricity through, for the AI play. I mean, these are all just going to just rocket higher and boom higher into 2025 and 2026. All right. Thank you for attending Investment Tuesday. I'll be back next week. Thank you and